everyone, and welcome to another episode of Mike and Twee Show. Is that what we call it now? Well, today we're going to be discussing the very hot and trendy topic right now on it is the 50 years mortgage. So Trump has floated this idea of a 50-year mortgage. So what do you think, Mike?
Oh man, I think this topic's a little crazy. I mean, there's a lot to say, I think, on 50-year mortgages. I mean, in a nutshell, if you just want to know the in a nutshell answer, it's don't do it unless
That's
you are very strategic and you have a grand master plan of how you're not ultimately going to hopefully pay interest for 50 years. But I don't know. What are your thoughts, Twee?
Well, I think on the surface, it sounds like, oh, good idea, let's lower the monthly payment.
Mhm.
However, in the long run, you are going to be in a world of pain because we just look at the number, we just crunch them. And for $1 million home here right in California, that's somewhere average,
Mhm.
we are looking at on a 30-year mortgage, you're looking at about $5,800 for a 30-year fix. And we're looking at 20% down. But if we were to change that to a 50 years, and wait, and by the way, for a 30 years mortgage on $1 million home, you look at
Mhm.
about 900,000 for interest, right? But on
Mhm.
a 50 years, your monthly payment from 4,700 is actually only lowered to 4,200. So
Mhm.
that's a $500 difference. But in the long run, you're paying $1.7 million in interest rate. So it's essentially almost double, which
Mhm.
is a lot just for an extra 20 years. Yeah.
Yeah, no, that's crazy. And that's unfortunately just how loans work, with interest being front loaded essentially. And yeah, I mean, for just 20 more years of payment, you only drop your payment, $500 a month, but you basically double the amount of interest you pay over the loan. And it's already a large portion. In fact, how much is it already if you do a 30-year fixed in terms of, I think if you finance 800,000,
4,700.
what's that?
Yeah. You finance 800,000. The monthly is 4,700 roughly.
Yeah, and
Yeah.
total interest paid is over $1 million on just that alone, right? So more than the total amount financed by about 200,000, correct?
Yeah. So it is around 900,000 for the interest rate under 30 years. But if you make it a 50 years, then it's 1.7 million in terms of just the interest rate, just the
Yeah.
interest alone.
Well,
So your $1 million home, actually, by the time you're done, is you end up paying 2.7 million instead of about 1.9 million.
yeah, that's
So it's
crazy.
quite a bit more. Yeah.
Yeah. And not to mention, I think I read something recently that the average age now, I wasn't sure if it's in California or the whole country, it might be the whole country, of people that are buying homes is around 40 years old now, which is way
Yeah.
up there compared to 30, 40 years ago. And so imagine, I mean, at 40 years old, you're going to take on a 50-year mortgage. I mean, that's just nuts to do something like that. You're going to be in debt your whole life, be paying the bank forever. Chances are you're going to die before 90, and essentially you're just going to be in debt for your rest of your life, right?
I don't know. I mean, like, considering all the pharmaceutical, they are keeping people alive a lot longer, so you can live miserably.
Okay. Yeah, still in debt, right? At
Yeah.
89, paying off your
But
mortgage.
and actually another thing I want to mention, yes, because it's only $500,000 difference. So you look at that on a monthly basis or an annual basis, you're only saving 6,000. And in a 30 years,
$500 difference, yeah, a month,
yeah,
right? Yeah.
yeah,
So in
30
reality, oh, sorry, go ahead.
I said in 30 years you only save 180,000
Hmm.
versus you actually having to pay 1.7 million in interest rate versus 900,000, which is a significantly way more than what it's worth, I feel.
So what should you do? I mean, obviously, if you can avoid, going for the 50-year mortgage, you should probably do that. Find something that's going to be $500 less a month to buy. Be conservative, or figure out a way to make $500 more a month, but don't step up to a 50-year mortgage just to save $500 a month. A month, sorry. But I will say though, caveat. If you are certain that you're going to make more money in the near future, or maybe you're going to be able to pay off the mortgage early, maybe you're going to get a lump sum of money in the future, something like that, and having the lower payment in the short run benefits you and you're pretty certain of the midterm or the long term, maybe not the end of the world to have that lower payment for a while until you're able to pay off the mortgage or to come up with that lump sum or whatever, right?
Yeah. Yeah. And at the same time, I feel like with these type of mortgage, we had actually discussed earlier, you're actually better off, um, either doing a 5 year fix or 7 year fix. And it's still a 30 years amortization. So you're
Hmm.
still going to save some money, right? On a 5 year fix, you essentially can change the payment at least, three, $400 difference. And when you can, or when the interest rate is lower, then you refinance and lock in a lower rate for a 30-year fix. That actually would make much more sense. Or in that one of the options you mentioned, actually buy a lower price home.
Yeah. Or you could do an interest only loan as well. That would be another option. So there's multiple options to avoid this 50-year loan. And on that note, it really just shows that it really isn't that beneficial of a loan when you really think about it. I mean, essentially, you're just tagging on almost double the amount of interest that somebody has to pay to buy a home for a marginal decrease in the monthly payment. I mean, why do that? There's really no benefit there if you really think it through, right?
Yeah. And that's where under the assumption that it's going to be the same interest rate as 30 years fixed. But in reality, right, it's probably going to be a higher interest rate for for a 50-year fix.
Absolutely, it should be. I mean, the rate's lower for a 15-year fixed and higher for a 30-year fixed because there's a lot more risk there to whoever's giving out that loan that they're tying up that money for an extra 15 years and they're going to want to be compensated for that. Imagine
Yeah.
50 years. I mean, you're going to make a loan today, that's going to go 50 years into the future when rates are 5, 6%. What if rates are 8, 10, 12, 15% in 10 years and 20 years? Now that loan is going to have dropped in value so much, you're going to lose your pants on it. And, that's going to create big problems in the future as well for the economy if a whole bunch of mortgages go bad.
Yeah, and actually, if you think about it, right, like you said earlier, let's say if you're buying a home when you're 30 on a 50-year fix, you'll be 80. So you would like well into retirement, you're not even be making money. So how are you going to pay your mortgage?
Yeah, absolutely. And I think no matter what mortgage you get, even if you get a 30-year, you really should try to do everything you can to pay it off early. Because if you make principal payments earlier on in the loan term, you really save a lot on the interest that you pay over the course of the loan. So it's one of those kinds of things. I mean, unless you're a great investor and you can make, more interest or more money elsewhere, putting chunks as you get them over time to pay off the mortgage early is actually really beneficial in terms of the amount of interest you pay over the loan term.
Yes. No, I think that's a great advice, Mike, because I do that myself. Like for our home, we do pay like every month like 300 to 500, a little extra on principal because like
Wow.
it is because I just moved into my home like 5 years ago. So
Okay.
we pay so much interest every time I'm looking at the how it break down. I'm like, okay, I gotta pay down that balance.
Mm-hmm. Yeah. No, it's smart to do that. Absolutely.
So the verdict is we think it's not a great idea at all. There are definitely many other ways to lower your monthly versus actually taking on more debt. Although it is the American way to take on more debt, we don't recommend it.
Correct. Do not do that. Bad idea.
Yes. All right, guys. Well, thank you so much for watching, and we'll see you guys next time.
See you later.